Hey, welcome everyone. I'm Ted Earhart. Just want to spend a few minutes today talking about the difference between patient, disciplined investing and speculating or market timing. One of the observations I've made about some of the greatest investors, including Warren Buffett or even the lesser known Seth Klarman, is they'll often hold a sizable portion of their portfolio in cash. And this can sometimes be 30, 40, even 50%. That cash can be extremely valuable when the markets go south every so often, as they always do eventually, and investment opportunities at that time become extremely abundant. For example, Warren Buffett famously invested billions of dollars during the height of the 2008 financial crisis when the markets were in free fall. Those investments ultimately produced huge returns as the crisis ultimately passed and the economy began to recover. Well, some people will ask, isn't this just market timing? Well, the answer is it totally depends on whether one is just making a speculative bet about the direction of the market broadly, or even some individual security, versus someone who's actually making a shrewd, calculated investment decision. For decades, Buffett has used a baseball metaphor to describe his investment approach. As he puts it, the market is throwing pitches, in other words, investment opportunities, at investors every day. And the beauty of investing is there are no called strikes. So you, as an investor, can just sit there for years, even decades, waiting for that absolutely perfect pitch that you can hit with a very high degree of certainty. But there's another important point here. What people like Warren Buffett do every day is they study these metaphorical pitches so they're ready and they can identify them when the opportunities ultimately present themselves. For example, in 2008, when Goldman Sachs and General Electric were desperate and needed cash, Buffett's years of studying these businesses had prepared him to take a big swing at these pitches as they came right down the middle of his personal strike zone. And he knocked them out of the park. This is not market timing. Buffett didn't spend a second thinking about whether the stock market was going to go up, down, or sideways over the next 6 months. Or he wasn't even concerned about whether the stock price of those businesses was going to go up, down, or sideways over the next 6 to 12 months. What he did was he made a shrewd, informed investment decision given the facts and the opportunity that came right down his personal strike zone. Now, to stick with our baseball metaphor, market timing, in contrast, or market timers, they're not even looking at pitches. What they're trying to do is predict what the market is going to throw. They're not looking at what's actually coming down their plate. They're just trying to totally guess on what the market is going to do. This is a very important distinction. I mean, imagine a baseball player who decides to swing or not swing before the ball is even thrown. This is the difference between investing and just outright speculating. So again, investing is all about just patience and preparation. So you're ready to make an informed judgment when a great pitch ultimately comes your way. Speculating or market timing, again, it's just nothing more than guessing before the ball is even thrown. So that's just a quick one for you today about the difference, at least in my opinion, what separates investing from just outright speculation. As always, I appreciate you tuning in, appreciate you watching, and appreciate if you throw me a thumbs up if you enjoyed the video. Thanks for watching.